Hello everyone, my name is Christian. Welcome back to Tekpon. Today our guest is Ignacio, the VP of Sales at Boopos. Hello.
Hello, Christian.
It's a pleasure to have you on the podcast. At first, please tell us what is Boopos.
So first of all, thank you very much for having me on the podcast. I had the opportunity to meet you personally at the event last
Yeah,
week at Bucharest. It was amazing. For every listener out here, I would strongly recommend to attend one of your events.
thank you.
So yeah,
Thank you.
just a quick short story about Bupo. So we started about 3 years ago. Initially, we wanted to buy businesses ourselves, kind of become the next aggregator. That's when the Thrasio, Elevator Brands, Heyday, they were all coming
Mm-hmm.
booming in the e-commerce space, right? So we said, why don't we just acquire businesses and do the same? We actually realized very early on that we didn't have any experience operating the marketplace and the brands. So we just said, listen, we all have experience in the banking industry. So we quickly shifted. We never acquired a single business, but we started offering financing for people in the space.
Okay.
We funded e-commerce, content sites, marketing agencies, SaaS, and basically we were a debt provider for
Mm-hmm.
people buying online businesses of every kind. Right? There were a lot of early aggregators that basically raised a little bit of equity. They weren't big enough or they didn't have enough traction to get venture debt or institutional debt. So what they did
Mm-hmm.
is they will leverage whatever equity they were able to raise. They partnered with us. They leveraged their equity, acquired a bunch of brands, let's say 5, 7 brands, and then once they had enough traction, they will then raise institutional debt from venture debt or bigger lenders, which they were able to get a better terms, and they will repay us off once they're able to secure that debt. Also, we had a lot of individual buyers and very sophisticated buyers that were used to buying and selling online brands in general. So we worked very well with them. Fast forward until now, we've deployed over 70 million in total. We just raised 175 million from Fortress, which is a venture debt fund based in New York. And
Mm-hmm.
somewhere in last year, I think it was June or July of last year, we went through our portfolio review and we noticed that the performance on e-commerce was not as good as in the performance of SaaS. So essentially, we shifted again and we started offering financing only for subscription based businesses. So that means SaaS, software as a service, marketing agencies with our recurring model. We can still do e-commerce if there's a subscription box, so
Mm-hmm.
essentially, anything where we could understand the churn and the client retention rate, we can offer financing to. And then also at the last, yeah, at the end of the last year, some of our clients reach out to us because they wanted to sell their business. So we started helping them out because we've created a network of really interested and potential buyers in the space. So they wanted to sell with us, and we started a sales side advisor. We
Mm-hmm.
expanded to people outside our network. So right now, Boopos essentially is a M&A acquisition lender and a sales side
Okay.
advisor. That's basically what we do in a nutshell.
Thank you for the story. It makes total sense. But is there a marketplace where buyers can connect with sellers, or they do it directly to you?
Yeah, so we actually have a marketplace where we reunite not only the proprietary deals that we have, but
Mm-hmm.
also other broker deals. So we curate each deal individually. We analyze every deal on the market. So essentially, when you come on our marketplace, you're going to find deals that are from Flippa. You're going to see deals that are from Acquired, Quiet Light, and many other brokers, and also proprietary listings. So it's essentially, if you want to find a place where they have the most curated listings that have individually been analyzed and we make sure that they have good metrics, you come to our marketplace and you'll have a curated marketplace for online businesses. And then you could also find deals that have financing attached to them, the ones that meet our criteria, and other
Mm-hmm.
deals that don't have financing because they don't meet our criteria, but we feel like they have uh, strong metrics. So we also like to post them on our marketplace.
Okay, makes sense.
And then
And
sorry, yeah, one more
Yeah,
thing is
please,
there
please.
obviously there's some deals that we don't post on our marketplace. There's stronger deals, let's say more robust, which they usually go to bigger buyers, more institutional buyers, and usually those ones we don't post on our marketplace.
Okay. What is the criteria to list a business on Boopos?
So first of all, it has to be an online business, right? We haven't crossed that line to traditional businesses yet. Although me personally, I'm very much in favor of going that route. I don't know if it's going to be in the short term, but who knows?
Yeah.
But essentially, it has to have at least 100K TTM revenues, and then it has to be profitable, and it has to
What
be
do you mean by TTM?
trailing 12 months. So the trailing 12
Okay.
months revenue has to be at least 100K. Now,
Mm-hmm.
for the smaller ones, we just post them on our marketplace, and then once you're above 500,000 in TTM revenue, so trailing 12 months revenue, we will do a more advisory program where we potentially reach out to buyers and we do a more curated search in order to sell those businesses.
And you advise both buyers and sellers, so a buyer can come to you and say, okay, I'm looking for a business in this niche with this revenue. Do you have any recommendation?
Yeah.
Or is it only for sellers?
No, for both. So actually,
For both.
we're divided into two teams, sell side and buy side. The
Oh,
sell
okay.
side team basically takes over the relationship with the sellers. They onboard them on our platform. They help them put everything together, SIM, financials. We have our analyst team that go over the financials. We make sure that we go one by one to take the SDE out and really clean out any expenses that won't be staying or transition to the new buyer. And we essentially help them with the initial conversations with potential buyers. And finally, gather the LOIs or the offers, and we help them decide on which is the best offer. And then on the buy side, we help buyers buy businesses and also get financing.
But a deal can be done without financing as well, right?
Yeah, a deal can be done without financing on our marketplaces. Exactly.
This is just a bonus from your side that probably nobody else offers.
Yeah, exactly. Ultimately, our goal is we want to have a marketplace with embedded financing where financing is not is only an option for those who actually want to
Yeah.
use financing. But we have a lot of institutional buyers that actually have their own funds, so they don't want to use our financing, which is completely fine. And we're still in conversations with them because the deals that we have for sale obviously make sense for them, but they don't want to
Yeah.
get financing. So they're complementary to each other, but they don't have to go hand by hand.
What do you think is the biggest problem that Boopos solves?
Well, I think first of all, financing has always been a big issue, right? I think the only option for financing right now, we're focused in the U.S. mainly, although we do in Europe as well, but we're focused
Mm-hmm.
in the U.S. So I think in the U.S. the only option that you have it's the SBA route, especially for individual buyers. You have VC, but when you raise capital, you have to dilute yourself, and it's just a pain. You have to have experience talking to investors, raising capital. Not everybody knows how to go this route, and
Yeah.
it takes time, right? So when you find a really interesting deal, the best deals tend to leave the market very quickly. So once you find a great deal, if you have to raise capital to acquire the business, not only you have to dilute yourself, but it's going to take a lot of time, right?
Makes sense.
And then venture debt is very expensive. Usually, venture debt funds are not comfortable with smaller amounts unless you're building a roll up where you're drawing, let's say, 10 million, 20 million. Then it can make sense to have a conversation with venture debts. But other than this, SBA route was the only option. And SBA, the problem with SBA, they are quite cheap, I would say. That they're the best option financially, but they
Mm-hmm.
take personal guarantees and it just takes forever. So essentially,
What is a personal guarantee?
personal guarantee means whenever you get a loan, if you default on the loan, the bank has the ability to go after your personal assets. So let's say, for example,
Ah,
that you
wow.
own a house. The bank will say, okay, I'm going to lend you $1 million. You have to pay back in 10 years. But if you don't pay it back, I'm going to get your house. So that's a big risk.
Not good.
Yeah, especially on this online space where you never know what's going to happen, right? It's a
Yeah, yeah.
risky space to be in, although very profitable. But if you don't know what you're doing, you might get into a problem if you put your personal house as a guarantee. So basically, what Boopos solves initially is for financing people that want to have access to capital, quick access to capital, without personal guarantee, without diluting yourself. Then that's a problem. And then also for sellers, I feel like there's a lot of marketplaces nowadays, but they just like, oh, you go on your marketplace, kind of like self-service, right? You go there,
Mm-hmm.
you're responsible for talking to the buyers, you're responsible for kind of cleaning up the P&L, structuring the sim, having all these conversations with buyers, which it takes a lot of time. And ultimately, if you have a business, you have to focus on your business and growing your business. You cannot spend time, even if you want to sell, you cannot spend time doing all this work in order to sell the business. So basically, Boopos
Yeah.
solves two main problems: one, financing for buyers, and then also for sellers who want to sell. Basically, have a marketplace where we're taking care of everything, so you don't have to worry about stuff that you shouldn't worry about.
And for sellers, is there any difference if the company is bought via loan or directly?
No, so actually, when we offer financing on an acquisition, we actually fund the business right after the APA is signed. So the seller will receive the funds, like let's say the buyer's putting down 20%, and we're putting down the remaining with some seller financing. They will receive the amount simultaneously. So it's not like they have to wait for our financing to get to their account or anything like that. So it makes absolutely no difference for them.
What are the main challenges that founders face when looking to exit their business?
Oh, wow. So that's a really great question. So I think the first one is valuations. I think we're
Okay.
still a bit discoordinated between seller expectations and the market reality. So I think buyers
Mm-hmm.
tend to adapt a little bit faster to valuations and market trends than seller expectations, right? So we still feel like whenever we talk to sellers, they don't have a clear understanding on what the market multiples are, because they basically don't have as much information as how many transactions are done, what are the multiples. So I would say the first challenge is basically understanding that the market changes. So whatever your business is worth is not always the same, right? It has to do with obviously who you're selling the business to, either if it's a strategic buyer, what the market trends are, if there's financing or not financing. So even the same business with the same market multiples, if the interest rates are high, people have less access to capital because capital is more expensive. So if there's
Right.
less capital in the market, automatically the valuations are going to lower because there's less
Mm.
ability for buyers to get capital to fund businesses. So I would say the first one is that they don't have expectations clear on market valuations. I would say the second one is that sellers are not aware that selling a process takes time. And whenever you decide that you want to sell the business, it's not like, hey, it's not like a house. A house is quite simply just, hey, I want to sell my house. You put it on the market. That's it, right? You clean your house a little bit, and that's basically you're
Yeah.
ready to sell. Whereas a SaaS, you kind of have to prepare for an exit. You have to clean your financials. You got to make sure that your financials look right. You got to talk to your tax advisor. You got to talk to your accountant. You got to clean the P&L. You have to prepare the cohorts. I'm still surprised by the fact that whenever we talk to sellers, not everybody knows what a cohort analysis is. They don't show the retention. They don't track the retention of their customers as much as buyers want to see, right? So I would say the second challenge is actually preparing your business before you want to sell. So the process shouldn't say, hey, you decide to sell and then you sell. It would be, all right, you decide to sell, you prepare for an exit, and then you try to sell the business. And then
Right.
the third one I would say is just going back and forth with the buyers and understanding that when you want to sell a business, there's a couple of things that you have to take into account, and one of them is a deal, how you want to structure a deal, or how open you are for different deal structures. I think sellers are not very not. I don't want to say realistic. I think they're not used to the deal structures that buyers put up when they make an offer. So when you sell your business, you say, okay, you go through evaluation. Business is worth 1 million, and unfortunately, that doesn't mean you're going to get 1 million up front, right? So you have to start
Yeah.
thinking about, okay, are you willing to do seller financing? Are you willing to do an earnout? How confident are you about the growth of the business? Are you willing to sell, let's say, 90% of the shares or the equity? Do you want to do rollover equity? Are you willing to stay for a year, for 2 years? So I would say that sellers are not prepared for that conversation before they decide to sell. So I would always recommend sellers to kind of think about those things before they want to sell. Like, how confident are you on the growth of the business? Do you like earnouts? Do you understand that seller notes are very common in the space? And are you willing to accept a seller note? And how long you want to stay in the business? Are you willing to sell 90% if a buyer offer you kind of to keep a percentage of the business? And that would be the third challenge I'd see in the market.
That's appreciated. Thank you. How about the market? How do you see it? I know you have a lot of takeaways. How do you see it nowadays in
Man,
2024?
it's a roller coaster. I must tell you, it's fun and frustrated at the same time. I wake up one morning and I'm like, man, we're gonna kill it. This is gonna be a great week, man. We have so many mandates. We're having so many discussions. Buyers are very active. And then the next week, I'm like, oh my god, man, this is hard. Interest rates are racing again. It's gonna be more
Yeah.
complicated. Buyers are not responding anymore. So it's just a roller coaster. But I think overall, it's just one of those things where people, when we look at how many wars are happening right now, right? It's like, oh my God, there's so many wars happening. But when you look at the big picture, things are actually
The list in the
better than they
history.
were 200, 300
Yeah.
years ago, right? So I think with the M&A space, it's kind of the same. We only look at a small period of time, let's say 6 months, 1 year. But when you look at the overall picture, I think it looks good. I am very positive about interest rates lowering at some point this year. I don't expect them to lower very, very much, but something that kind of help buyers get access to more capital. And I think
Hmm.
overall, second semester of 2023 was very, very hard. I think sellers wanted to hold on to the business because they were expecting higher multiples, so they rather kept their business and wait for multiples to go back to what they were before. Now, I
Yeah.
think expectations between buyers and sellers are starting to get a little bit more aligned, and we are starting to see much more activity than we saw actually on the second semester of 2023. So I'm bullish on the market, but again, it's just a roller coaster. Today's Friday, so maybe I'm a little bit more positive. If we have the same podcast on Monday, I might have changed my mind on that answer, to be honest.
I appreciate the honesty. Um, but how do they decide on a valuation? Is there a negotiation? Is there a partner, a third party? How do things usually
Yeah,
go?
so actually that's a very interesting question. So valuations, first of all, the market, like valuation is just a metric that determines how much we think the business could be worth. But no
Hmm.
matter how much I think your business is worth, Christian, at the end of the day, is whatever buyers are willing to pay for the business, right?
Right.
That's what the definition of price actually is, right? So, however, you can do some really good estimates on what a business could be worth. I think the most effective data is past closed deals on the market, and we have a lot of
Hmm.
information on that. So whenever we talk to a seller and say, all right, what's your valuation, we actually run two analysis. One is on financials, and we have metrics on, I don't know how many deals we've analyzed so far, maybe 1,000 deals we've analyzed. So we take metrics. All right, what's your TTM revenue, and we compare that to the average of let's say a sample of 50 deals or 100 deals. You don't want to look at it too high of a sample, because if you take a very broad sample size, you might take businesses that were for sale 6 months ago, 7 or 8 months ago, and the terms change, right? So you want to keep it. All right, what were the deals the past, let's say, 5 months? What did they look like, right? And what was their valuation like for the past 5 months? So we look at all the revenue metrics, profit metrics, how much they spend in marketing, what their cost of goods sold are, and we basically compare every of those metrics to the median of the sample size that we take. So let's say we do a bell curve. So let's say we take samples of the last 50 companies, and you have the bell
Hmm.
curve. Well, 5% of the companies
Okay.
spend this on tacos or cost of goods sold, or this is the retention. The 50%, the median is here, 95%. So we do that, and we compare each of the metrics, the revenue, profit, tacos, retention, and all that, to the sample size that we chose. And then from there, we compare, okay, your metric compared to the median of the sample size, and we'll give you a score. Finally, we add all those scores up and we compare it to the median again of the valuation of the market, and that's one
Okay.
metric that we will use. Then you have to look at
Mm.
transferability. How easy is the business to transfer to another owner? Platform risk, like you might have the best metrics in the market, but if you're dependent on a third party platform to basically run your business, that might be considered as a risk for many buyers, right? So we take that into account. Also, how well are you running your code? How well is it maintained, security, and all that? So we take financial metrics, transferability, vulnerability, and dependency on other metrics. We add all that up to get a valuation, and then finally, the most, like what I've said, the most important thing is other businesses that have sold in similar size in the market that will determine the valuation of a business. But even when we do all that analysis, some sellers still say, yeah, but my business is worth more because X, Y, and Z, which, I mean, sometimes they are right. You know, it's a
Yeah,
battle
yeah.
between sell side advisors obviously want to sell the business, which is fine. They know the market, but you know your business potential more than anybody, right? So although yes, you should listen to people that have more metrics to give you a fair valuation, you should also be worthy of how you think the business has potential, right? So it's just a mixture of those two things.
What are the main reasons that founders sell their business and buyers buy a business from your experience?
So I mean, the main reason sellers sell their business is because they want to capitalize on their work, or they want to move
Hmm.
to different projects. They worked on a similar business for many years, and they're ready to move forward on another projects, or they just want to make sure that they capitalized on their work in order to secure the capital and invest in other assets, right? That's one reason. And then buyers, they want to buy because it's a cash flowing business. It has the potential to grow. You have the potential to basically do the same when you buy a business, you make it grow, and then you sell at a higher multiple, or you want to do a roll up strategy where you add a bunch of businesses up. And ultimately, if the valuation of a business is mostly based on EBITDA or SDE, if you buy 5 companies, you put them together, just by increasing the size of overall valuation, you are going to get a bigger return of investment.
You as a marketplace have the chicken and egg problem like any marketplace. From your side, is it harder to find sellers or buyers?
I would say it's harder to find good sellers. When I mean sellers, I mean good businesses to sell. Because once you have a great business, you're not going to have any issue finding the right buyer. So
Mm.
sometimes, like I would make the differentiation between, if it's a great deal, then it's way harder to find that great deal. Because once you have it, buyers just, they will come by themselves, right? You'll reach out and they'll be like, yes, absolutely, I want this opportunity. Thanks for sending it over. So yeah, I would say finding a great deal is way harder than finding a great buyer.
And usually, is it a bootstrapped founder?
Yeah, most of the deals that we work with are bootstrap, I would say. When you go
That's
to
your
the
sweet
VC
spot.
route, I'm not very keen on raising capital, especially at the early stages of a SaaS, because I mean, like, you have all the tools to grow a SaaS without raising capital. Now, there's different situations where you do need to raise capital in order to maintain growth,
Yeah.
but 95% of the people that we work with are bootstrap for sure.
Okay. And from the buyer side, what do you see the most? Is it PE firms? Is it bigger SaaS companies? Is it funds?
I mean, it depends. I would say in number of, if you count one by one, there's more individual buyers. But if you count the number of, let's say, dry powder that they have, there's at least 200 to 300 institutional buyers in the SaaS space that have a big runway, or have the ability to deploy a lot of cash, right? So I would say in terms of numbers, there's more individual buyers, but in terms of capital potentially provider, institutional buyers have more ability to buy bigger brands and more robust businesses.
How does Boopos make money? How do you earn?
Yeah, so first of all, we do sell side fees, which is the most obvious. We do not have a retainer. Some other sell side advisors charge a retainer.
What is a
So a
retainer?
retainer means, let's say you're selling your business, and you know that on average deals tend to delay 6 months until they close, right?
Yeah.
The time it takes for you to sell a business has increased. It used to be 3 months, now on average about 6 months. So what some sell side
Mhm.
advisors do is, given that you're putting a lot of work and you don't know if the business is going to sell, you get a retainer, which is, all right, I'm going to charge you, let's say, 500,000, I mean, sorry, $500 a month, or $1,000 a month, $3,000 a month, in order just for me to work on the business, create the sim, clean out the financials, reach out to buyers, and then ultimately, if it doesn't sell, it's not because I didn't do the work and I have to get paid for the work. And then you get a
Oh,
sell
okay.
side fee. So we do not work with any retainer, but we do get
Okay.
a sell side fee if the business is successfully sold. And then also, obviously, we have interest rates for the debt that we create, and we get paid on those interests.
Okay. And is there any specific amount of months that you loan the money to? Like 6 months, 12
Yeah,
months,
we
or
do 4 year terms on average.
okay.
So yeah, we get paid every month, but on a 4 year term loan.
What are the benefits and the risks of loaning money to buy a business?
So I would say the first benefit is that you don't have to put your own capital. So it de-risks your ability to lose money if the deal doesn't go the right way, right? The second
Okay.
benefit is you can buy multiple deals, and you basically don't put all the eggs in one basket, right? So let's say you had 1 million, right?
Yeah.
You have two options. You could either buy a business that's worth 1 million, right? And you put all the eggs in one basket, and you grow the business, let's say 10% year over year. In 4 years, you have 1,400,000, and then you sell it, whatever, right? Or
Yeah.
what you could do is you could leverage your equity. You can create different structures to acquire businesses. You can leverage with us. You can partner with us, and you can buy three businesses worth 1 million each, where you're putting 300,000 down. Let's say you don't over leverage because you don't want to take on too much debt for your existing business. So you do 1/3 equity, so 300,000, 300,000 in debt, and 300,000 seller note. Approximately, because it's 300,333, but just to make
Yeah.
round numbers. So you do that three
Yeah.
times. So you buy three businesses worth 1 million, where you're putting the same amount of capital down, but you end up with three businesses down the road. Again, if you grow at 10% year over year for 4 consecutive months,
You pay
after
the
4 years, the debt is already paid off. You sell
yeah.
three businesses instead of one. So that's the main advantage. So that's, you always
Wow.
want to leverage your equity in order to create more wealth and get access to more assets. That's the main advantage, right? The disadvantage would say, I mean, debt could be expensive, especially on this situation. And debt, you have to be careful with working with debt. Some people are too confident when using debt because they understand the power of it. But if you leverage too much, it comes to a position, you can come to a position, if things don't work out the way you want, where you're in real trouble, right? And it's like, if your
Oh.
revenues don't increase and they actually decrease post acquisition for whatever reason, and then you have to pay too much debt because you over leverage, let's say 80%, 60%, 90%, or whatever, then you have to service that debt. Now, all of a sudden, you don't have as much capital to spend in marketing, or you don't have enough capital to hire a developer and grow whatever business specific thing you want to grow, right? So then all of a sudden, you go into this down south spiral where you have to service the debt, you cannot grow, and then everything goes on a downtrend. So debt is very tricky. If you use it right, it's the best tool to increase wealth and grow your business. If you over leverage, so it's a how they call it, double edged sword, right? You got to be
Yeah.
careful
Yeah.
with
Yeah.
it, but
Yeah.
it's a great
Exactly.
tool. Like
Yeah.
for me, I want to die with as much debt as possible, right?
Yeah. Absolutely. Yeah. Great explanation. Thank you. Yeah. And now I'd love to hear your background story. Basically, how I started your career.
Okay. How back should I take it, Christian?
How long you want? We have.
All right. I would say that first of all, my dad was in the Spanish Navy. He's an admiral in the Spanish Navy.
Hmm.
So I grew up changing countries and cities every 2 to 3 years. After the World War II, the U.S. set up military bases around Europe. So I grew up going to American school, uh, French school, Spanish, different cities, just go on hopping
Wow.
from base to base. So it was quite challenging and kind of adapting every 2 years to a completely new environment, completely new friends. So that's one thing. Then I went to university. I used to play rugby. So funny story. I was a professional rugby player. Uh,
Nice.
During university, I used to play for the Spanish national team. And then when I finished university, I had to make a decision: do I start working now, or do I stretch this sports career a little bit more? I knew that rugby is not a big sport in Spain, so it's not like I could make millions like the Real Madrid players or anything like that. So I knew at some
Yeah.
point it was going to come to an end. It's just a matter of how soon or late you want to step off that train that ultimately is going to hit a wall, right? So
Yeah.
I stretched it a few years, but I was able to qualify for the Olympics in 2016. So I went to the Olympics, and after that, I decided that it was time to start focusing on sports. I actually tried for the NFL for a couple of teams. So I did a couple of tryouts with the Tampa Buccaneers, who ended up winning the Super Bowl a couple of years later, and the Pittsburgh
Wow.
Steelers, which I had a brother
Oh,
that played for 7 years. And yeah, after that, I stopped playing. And then I started working. I got into fintech, got into
how old were
M&A.
you when you started working?
I was 25 at the time.
Yeah.
So I
Okay.
went in 2016 to Olympics. I was 25. So I started working. I should have started at 22 perhaps, but I delayed my story for 3 years. And then
Yeah.
I got into fintech, and I had the chance to meet the VP of sales at the fintech that I was working with. Had previously worked with Juan Ignacio, which is our CEO, which, by the way, was the co-founder and CFO for 9 years for one of the first unicorns in Spain called Cabify, which is similar to Uber
Oh,
car sharing. So he started Boopos at the same time that I was working with for this VP of sales. And when the two of them got together to start Boopos, obviously he called me out and said, "Hey, you want to join us?" So I was actually the first employee. I don't know if I should say employee or founding team, but I
founding
was
team.
actually the yeah. So the first one on board
Yeah.
for Boopos, and then the rest is history. I've been here for 3 years, hopefully for many more years, and we can make this a unicorn at some point as well.
That's amazing. Do you have any piece of advice for somebody that's just starting their career?
So I would say, first of all, be curious about learning things, and then read. I wasn't a big reader when I was in high school or all the way through college, but then I realized when I started in sales, and when I started working, actually, I realized that I fell behind of my colleagues that started right after college, and I see like if you I try to do everything related to sports, and all the examples that I give out is just based on my experience being a professional athlete. So right now you cannot go to any athlete and ask him, "Hey, do you work out at the gym?" and get a no for an answer, right? Every single athlete in the world, you name it, golf, tennis, ping pong, Formula One, soccer, rugby, whatever, they
Yeah.
all practice for many hours, and then they do extra work on the gym to gain
Yeah.
strength, right? You don't gain any ability in the gym, but you actually gain the tools to be a better player on the field. So
Right.
when I started working, I realized that reading is, to your business career, the same as hitting the gym to your athlete career. So if you want to improve, given that, because you don't have time to be better on your day to day, right? You just grow at whatever life gives you pace, right? But
Yeah.
if you go to a gym, you could actually increase your ability twice as much, 3 times as much. So my first advice be just reading, which takes me to the second one, is be curious. Like, you have to be curious. You have to ask yourself. You have to ask a lot of questions. one thing that really kills me, because obviously being from the sales team, I do a lot of outreach to many founders, many people in the space, and
Yeah.
sometimes I get ghosted. We all get ghosted sometimes.
Yeah.
People don't reply. But I'm like, how many times people have reached out to me and I always reply. I'm always willing to get on a conversation with somebody. I'm always eager to understand other marketplaces, other business model. Even if somebody wants to buy a business that it's not e-commerce related, I know that I'm not going to be able to provide value or a loan. I'm still willing to get on a conversation with them because you never know what's going to happen. You never know what idea he can bring you, right? So I would
Absolutely.
say just be open to meeting people. You have to don't be like, no, this is not going to provide immediate value to me, so I'm not going to jump on a conversation. Just talk to people in general. Like if someone reaches out to you, hey, you want to sell your business? I know you don't want to sell your business now, but you never know in the future if you want to sell your business or you want to get advice.
Totally agree.
So I
Totally
would
agree. I love your mindset.
Yeah, so I would say first of all, read, be curious, and then just be open to meeting a lot of people, which you never know who's gonna bring you the next great idea.
Great. I have one last question for you.
Yeah.
Do you have a favorite software that you use and would recommend to others? SaaS?
So obviously HubSpot for us is number one, right? As a sales advisor or a VP of sale, you rely on HubSpot a lot. We're starting to use Dripify. These LinkedIn automation tools. I used them in the past, but I stopped using them for some reason. I used to work with Alfred. Now we're using Dripify,
Hmm.
and we're seeing that it works very, very well. So in terms of sales, I can give you my perspective on sales. We're using many
Please.
SaaS for other departments at the company, but in sales, I use Dripify, and it's been working very, very good. We also use Apollo. I mean, all
Hmm.
these automation tools and search tools are actually great for us. And LinkedIn, obviously, being number one.
Of course. Is there anything else that you want to mention today on the podcast? I love the conversation, so much value. I put a lot of questions and was curious and learned a
Yeah,
lot.
no. The,
But
the only
if you want
thing
to
that I
share
would,
anything,
yeah, absolutely. The only thing I would say is any SaaS founders out there that perhaps are listening to this podcast, feel free to reach out to me. I'm not one of those sales guys that are always trying to sell anything. I'm just really genuinely looking forward to meeting people, learning their story, trying to see if I can connect them with somebody that might be interested. I've met so many people that initially wanted to use our financing. They didn't end up using our financing, but I still kept the contact. And every now and then when I meet somebody, I just make an intro directly on email and say, hey, Christian, you should really meet this guy. I
yeah,
think you guys are going to get along very well. So I would please just reach out to me on LinkedIn. Let's have a genuine conversation. Let's learn from each other. So that's just the last shout out I wanted to do.
perfect. Thank you so much. It was fantastic. I appreciate
Yeah.
it.
Thank you, Christian. I really appreciate it.